every major corporation is suddenly being forced to account for their exact carbon footprint. Whether you are navigating the voluntary carbon market or managing strict compliance inside the EU emissions trading system, the rules of engagement are being written in real time. Funds and corporate sustainability desks face immediate pressure to deliver precise, audited environmental metrics to their stakeholders. Trying to trade or report in these markets without institutional-grade intelligence exposes firms to severe regulatory penalties and misallocated capital. In this regulatory environment, maintaining a real-time carbon data feed has become a standard operational necessity. But getting that data means hitting a wall, built by a handful of legacy financial providers who control the market. Look at the baseline annual costs per seat. Bloomberg Terminal tops the market at $32,000. MSCI runs about $25,000. Sylvera sits at $20,000, and BeZero at $15,000. Contrast that with CRBN.credit, currently offering institutional access for $0 during beta. This pricing structure forces middle-market firms into a difficult position: either pay five-figure enterprise rates or piece together fragmented news feeds and hope the data is accurate. The question for any procurement team is whether these $30,000 contracts provide enough carbon-specific utility to justify the five-figure premium. Let's start by looking at broad-spectrum financial terminals like Bloomberg. We built this comparison matrix tracking 4 modern carbon workflow requirements: live VCM pricing, AI portfolio strategy, net zero reporting, and DeFi settlement. When applied to Bloomberg, the gaps are obvious. It lacks AI portfolio strategy, automated net zero reporting, and any DeFi settlement. Their new energy finance offering is a bolt-on module. It lacks the dedicated workflow tools needed to actively navigate the voluntary carbon market. FactSet follows a very similar model. They offer portfolio-level exposure, but the carbon component is merely a secondary feature patched onto their core architecture. Without these specific execution features, your team is stuck manually compiling TCFD reports and forecasting prices across disconnected spreadsheets. Handing over $32,000 for a generalist terminal is a highly inefficient capital allocation if your primary operational mandate is carbon execution. Next, we have the dedicated carbon research firms. These providers navigate incredibly dense environmental data to build proprietary project methodologies. Pulling the comparison matrix back up for MSCI and Sylvera, both platforms excel at independent project ratings and risk analytics. But look at the remaining rows. They fall short on operational workflow, lacking live trading feeds, AI strategy generation, and automated reporting. There is a massive functional difference between buying a static research report and utilizing a dynamic tool that actually executes your strategy. Yet institutions routinely lock themselves into custom contracts costing between $15,000 and $50,000 annually for precisely this static data. While their project ratings are respected, users pay enterprise rates for pure research while still lacking the execution tools required to act on it. This brings us to CRBN.credit, a terminal designed specifically for the data structures of environmental commodities. Looking at our comparison matrix one last time, let's examine the CRBN column on the far right. Because of its focused architecture, it covers every metric we've tracked, providing a stark contrast to the legacy providers. The platform includes an AI-driven portfolio strategy capability that actively automates how corporate carbon is allocated. It also integrates immediate CSRD compliance tools and facilitates trustless on-chain settlement via the Polygon network. The trade-off is straightforward. You give up broad macroeconomic and cross-asset equities data in exchange for hyper-focused carbon intelligence. By stripping out non-essential financial data, this architecture allows for a 160x cost reduction, while simultaneously giving you better tools for a specific carbon mandate. The right decision comes down to your exact pathway. You have to clearly separate traditional macro trading from modern environmental strategy. We can map this decision onto a scorecard with 3 distinct institutional profiles: the bulge bracket bank, the corporate desk, and the boutique fund. If you operate a bulge bracket bank, keep your Bloomberg terminal. Your cross-asset trading volume justifies the $32,000 cost. But if you run a corporate desk or a boutique fund, you should immediately adopt CRBN.credit for your reporting automation and live execution. Timing matters here.
CRBN is completely free during its current institutional beta. Once it jumps to a premium tier at the end of 2026, those free seats disappear. Onboarding is entirely frictionless. The platform is fully SOC 2 compliant, requires zero credit card commitment, and clears institutional approval in 48 hours. Paying legacy prices for fragmented carbon data is an obsolete strategy. Bypass the paywall and claim your early beta access using the link below.